The El Niño weather phenomenon has contributed to a severe drought at the Panama Canal, leading to the driest October since records began back in 1950. Now, the Panama Canal Authority has been forced to cut daily ship numbers. During normal times, the canal sees 34 to 36 ships daily. And by February 1st, that number will be cut by about 50% to 18 ships. The low water levels have caused delays, prompting price increases for shipments. Joining us now with his insight on the matter is Josh Eiermann, U.S. Energy Information Administration industry economist. Thank you for joining us this morning, Josh. So put this in context for us in terms of, this seems to be an issue that was sort of already in the making, but we're continuing to see this coming to the forefront. What is at stake here when we see what's happening with climate change and how it's impacting shipping and shipping costs?
Absolutely. Just to put into perspective, the normal number of transits that go through the canal range from either 36 to 38. So by February, this will be cut by more than half. What is happening is because of the fewer ships that are able to go through the canal, some ships are now taking longer routes to get to their destinations. So, for example, if a shipment is going from the US Gulf Coast to East Asia, some ships may choose to go through the Suez Canal, or they may choose to go around the Cape of Good Hope. So what we're seeing is that there are more ships now being taken out of the market, and then this is causing rates to be higher, among other factors.
So Josh, break down some of the domino effects, because if you look at the type of the commodities that go through the Panama Canal, especially these very large gas carriers that includes liquefied natural gas for the US, have we already started seeing that showing up in the pricing for LNG?
So for LNG prices, I'm not sure. However, for very large gas carriers, these carry mostly propane, butane. These are prices I have access to. These are rising quite a lot. However, the market did cool off a bit. So what we see is with the freight market, we can see prices going up, and then at a certain point, prices reach a level where charters and market participants will start to back off of the market. So then those prices will start to then decrease a bit. However, with the new restrictions that were put in place, we're seeing those prices now again start to pick back up. And of course, there's ships that have booking slots already that they booked ahead of time. And then I imagine now these booking slots are getting cut. So then that is going to push the vessels that are getting cut from the booking slots that they've already had booked to be now pushed further back. And then again, this is probably going to end up causing more delays at the canal.
And it certainly doesn't help that this is coming at a time when, most of the world is still experiencing high inflation. And as you noted there, when it comes to these bulk shipping companies, they have a couple of options. You can wait the extra days. You can pay, in some cases, up to $2 million to try and jump the queue in the line, or take perhaps a longer, more costlier route, but all costly whether from a financial perspective or from a supply chain perspective. Are we able to quantify how much that's changing and how much of that ends up being passed on to the end user or consumer?
So it's interesting because for propane, again, for example, we're not really seeing much of a change in propane prices, wholesale prices that are getting shipped. For container ships, because of the draft limits that have been imposed, these are making it so that vessels have to sit higher in the water. So to achieve that, a container ship then has to take containers off of the ship to then sit higher in the water so that they're not as low. And I imagine that that's having quite an effect in that industry because if it's not very economical for a container ship to be carrying 40% less of its capacity when it's going, all the way from East Asia through the Panama Canal to, say, the East Coast in Georgia or something.
So, Josh, I want to ask you, in terms of long-term solutions here, obviously cutting the number of ships is one. I mean, the New York Times estimating that the passage of one ship consumes as much water as 500,000 Panamanians use in one day. That's just from one of these ships. In terms of long-term solutions here, what are we looking at here other than cutting ships, and who could perhaps benefit from that?
So it is important to keep in mind that the Panamanian people also get their water supply from this lake. About, I believe, half the country gets water supply from there. And they also have hydropower that goes through the lake as well. So This is not just having an effect on the shipping industry, but this could have effects for the people of Panama as well. One long-term solution that I've seen floated around was building another reservoir for the canal. This would cost about $900 million. But in context, next year they're planning on, or the Panama Canal is expecting to lose revenue of about $200 million. So as a long-term solution, it seems like a pretty economical way of handling this. However, the building of the reservoir will take about 5 years, and it still has to go through the National Assembly and the government of Panama to reach that decision to build that.
We'll continue to track that. I remember the ship that got stuck in the Suez Canal. They were talking about the domino effects of cost there, so something we'll continue to keep note of.
Yeah.
Thank you for joining me this morning, Josh Eiermann, U.S. Energy Information Administration Industry Economist. Thank you so much.
Thank you so much.